So I just spoke to the managing director of the IMF, Kristalina Georgieva, started with asking her about the better inflation numbers that we got out of the U.S. this morning, more evidence that that high inflation rate is coming down. Here's what she said about it.
What we see is what we should expect to see, that the determined action of the Fed is going to pay off. And even more importantly, it has been a synchronized action of central banks all over the world that has given us this trajectory in the right direction, inflation going down. But core inflation is still high, and it is sticky. So the Fed will have to persist in pushing it down. Why do we need that? Because without price stability, we don't have a sound foundation for growth.
So you see more work to do here for the Fed, more rate hikes, more than one?
I'm not going to make projections of how many. What I can say is that the Fed will continue to be guided by data. And as long as core inflation is not in the territory it has to be, the Fed will have to persist. What we expect is that this stickiness of core inflation is going to go through this year. Hopefully we would see it melting away next year.
The problem is the economy has also cooled off, and we're seeing increasing evidence of that. So the question is, can they get away with continuing to hike without dragging the U.S. into a deep recession?
What is bad news turns into good news. The fact that the economy is slowing down, of course, would lead the Fed to recalibrate their own policies. So the skirmishes in the banking sector are actually helpful because they do lead to especially medium-sized banks being more careful in their lending practices. They provide 30 to 40% of financing, and meaning that they are helping the Fed by being more prudent for the Fed not to have to do that much.
In other words, the whole banking crisis is very disinflationary. You see it?
Not very disinflationary, but it has been a helping hand to the Fed. But let me just correct you. I don't think there is a banking crisis.
Okay.
There are vulnerabilities.
A few banks were in crisis
that we should have expected. Let me say that we have lived through a long period of very low interest rates and ample liquidity, and then very quickly we moved into high interest rates and restricted liquidity. Of course, there would be vulnerabilities to be exposed. And what is positive is that action has been taken very swiftly when that happened.
Is it contained?
At this point, we see it as being contained. But our message in these meetings, be watchful, vigilance of supervisors, regulators, the Fed, the finance authorities here. This is what is going to make a difference, because there may be more of these vulnerabilities to come to life.
There's also a question of just how much banks are going to pull back on lending and what sort of credit crunch we might see. It's early yet, but what are your expectations there?
Well, at this point, what we see is that labor market is still very strong. Consumer demand is still very strong. And what it says to banks is, well, hey, there is business out there. So a credit crunch not on the horizon, but some care in lending practices, yes, and actually this is a very healthy thing to have.
So this was one reason, the risks in the financial system, I won't call it a bank crisis, that you guys were very cautious in the latest global economic outlook, rocky outlook, you called it. What are you so worried about? Did you mean to strike such a cautious tone?
We did mean to strike a cautious tone because we have to be very clear that we are moving in a different stage of the cycle, with the interest rates inevitably having an impact. Cannot be that interest rates go up and they have no significance for how much businesses and households borrow and how much the financial institutions are willing to lend. There is impact. But we also are very careful to say that this is a prudent approach to shift in financial conditions. Tighter financial conditions is what we live with today.